welcome to the Q&A follow-up for Unlocked Success in 2024 tax season prep for your childcare business with Mohamed and Charles. My name is Charlissa. I'll be asking the questions today, but the real stars of the program are going to be Mohamed and Charles, who are going to be answering all of the questions that you guys asked us. We got some questions on business structure and entity types. I am a sole proprietor paying too much in taxes. Is it too late to open an LLC for the year of 2023?
No, it's not too late to open an LLC for 2023. You should definitely do that. As far as paying too much in taxes, in order for you to minimize your tax liability, that LLC has to also now be converted into an S Corp. And so both need to happen before the end of the year. S Corp allows you to pay a lot less in taxes, but depending on your income and expenses, and I would definitely recommend that you speak to a tax preparer or an accountant to be able to advise you, does it make sense to convert to an S Corp or stay as a Schedule C LLC? But it's not too late to get an LLC.
If I may interject though, remember today it's December 18th, and at least in our state of Georgia, they shut off forming new entities at December 15th for the remainder of the year. So that may be a barrier to actually benefiting from it this year, but it's the New Year's resolution for many, particularly if you're in Georgia, to make sure you do that in January following the new year.
Now, is there a certain amount you have to make to qualify to change an LLC to be an S Corp?
No. So normally, as a rule of thumb, what I use is a net income after expenses of $30,000. And the example that I provide is if your net income after expenses is $30,000, on an LLC, you'll pay about $6,000. On an S Corp, you'll pay about $2,000. Now, that number might adjust or change. As long as it's a higher number than 30, you would probably be well advised to convert to an S Corp. But again, $30,000 would be the net number that I would say would be a time for you to consider switching to an S Corp.
And how does an LLC work for an in-home providers when everything is combined?
So an LLC essentially limits your liability as an operator. And the fact that you're sharing a part of the house with the business does not negate your liability. The part of the house that you're using, you're going to be able to write off on an 8829, but having the LLC limits your overall liability, and then the house that you're splitting will be put on an 8829. But an LLC is essential to limiting your liability, especially in the industry that we're in.
Between sole proprietorship and LLC, which one would you recommend for a family daycare provider?
So between an LLC and a sole proprietorship isn't really an option. The idea that you're operating as a sole proprietorship increases your liability infinitely. You are liable for anything that happens with any of the kids to an unlimited amount. Having an LLC and operating under an LLC is the only advisable option available to a business owner, is setting up an LLC and maintaining that separation between personal and business, having separate business accounts and operating your business as an LLC, because while you're limiting your liability and you're not putting your entire net worth at stake.
What is the percentage I should deduct for federal and state tax monthly from my income?
So if we're thinking about filing as a Schedule C, what is advised that you do is not deduct monthly, but do quarterly payments. And so when you filed your 22 return a couple months ago or in April of this year, you received a 1040 ES, which is an estimated tax payment that your accountant or your tax preparer prepared for you. And those payments were due in April, June, September, and then again next month in January. It's better for you to do the quarterly payments. The only time that you would have deductions from your pay is when you have payroll, and normally payroll only comes into play when you have an S Corp.
Can I file as a sole proprietor and then as an S Corp the next year?
Yes, but again, what we advise is never filing as an S Corp, but filing as an LLC. But if you file as a sole proprietor for this year, as Charles was mentioning, in the state of Georgia, January 1st is when you'll be able to open that LLC. and you can get that LLC converted into an S Corp in the beginning of the year. So yes, you can.
Okay, so it's too late to open an LLC for the year of 2023.
In the state of Georgia, it is, but in your state, it might not be. Go to the Secretary of State of your state to see if it's too late to file an LLC.
Wow, thank you, Mohamed. That was so helpful. I didn't know any of that. I'm going to go ahead and switch on over to Charles. We got a hint of all of his knowledge, but I hear the godfather of childcare has more to give us. So I'm going to start with some CACFP questions. Why do we pay taxes on the food reimbursement money since it's a reimbursement?
Even gifts from heaven have some cost to them. There is a tax, but any kind of grant income given to a operating for-profit business is considered taxable income by the Internal Revenue Service, and the food program payments are in the same category. They are a reimbursement for the food costs and the cost of delivering meal service to the qualifying children, but at the same time to the business, they're earned income, and the IRS accordingly considers them taxable.
Do we pay taxes on food program payments?
Well, by payments, I assume you mean what you are spending. With the food program, you track both the cost of the food products and utensils, soft costs that are involved in the meals that you serve, as well as that tracking is to ensure you're in compliance with USDA, nutritional standards. But those costs are what you've invested in the cost of that delivery of service. They then will reimburse you for the expenses where you've been compliant with their nutritional standards. But that reimbursement is taxable.
Should I save receipts for my food program expenses?
It's essential to save receipts for two reasons. Number one, you'll need those receipts on the one hand to file your claim each month for what you're seeking to be reimbursed for. But it's also a good idea, while you've organized them and totaled them and so forth, is to have that available for the potential future audit, that if any of your reimbursements were called into question, you may be subject to an audit by USDA for reimbursements you've previously received. And let me take this opportunity to mention that a lot of childcare operators leave a lot of money on the table that's eligible from CACFP. Namely, you're able to actually seek reimbursement for the cost of the real property in which your kitchen is located in, a prorated share of the building that you occupy, which is used for preparation of meals and serving meals. The same goes for labor. So the cost of your food preparer, your chef, any servers you may have, including a prorated amount of the time your teachers spend serving and cleaning up from those meals, those are all reimbursable expenses through CACFP. And a lot of childcare operators sort of don't like the idea of the extra paperwork that's involved, but it can be very rewarding if you're willing to make that effort.
If I could jump in on that, like I said earlier also about the receipts, making sure we keep them in a digital form is going to help you in the long run. Receipts fade over time. And so what Charles was saying earlier was about the reconciliations and also the audits. If these receipts fade, is as if you had no receipt at all. So making sure you keep them digitally would be great.
Do we have to report grant money received?
Just like the CACFP, a grant is unearned income, regardless of the source. And during the post-pandemic period, we've seen so much money come around. The only grant that wasn't taxable was the PPP program, because that was more of a rebate of previously paid taxes. But the stable grants, the various grant programs targeting specific improvements around childcare properties, such as playgrounds, such as educational materials, such as training teachers, Those are all funds that the operator gets paid to provide enhancements to their own business, and they are taxable.
Do grants need to be claimed on taxes?
Yes, they are accounted for as a cash receipt. And, again, if the operator were to choose to try to sort of ignore that and just report their normal operating income without that, they're still subject someday to possibly being audited, and that could have reverberations in the future if they didn't report that income.
Essentially what we're saying is if you spent $50 on a meal and you were reimbursed that, by not including the income and only taking the $50, you're overstating your expenses, because that $50 that came in really was to cover that $50 that you spent. And so by only reporting the expense and not the income, you're over-reporting your expenses, which means you're reducing your liability. And if it's over 25% of your overall income, IRS can audit you for life. If it's not, it's up to 6 years.
A lot of these grants, while they are taxable per se, they also come with specific uses that are often deductible. So if it's for the construction of a playground and the grant is for $10,000 and you spend $9,500 on the actual equipment and the mulch and the fencing and so forth, and there was $500 allowed for the administrative part of that, that $500, if you, the owner, kept it as personal income, then that's the only part of that $10,000 that is taxable. So typically grant income is not as big of a bite as people fear it will be. Same with the food program.
Will EEC send a tax document for the C3 grant?
My observation has been that a lot of the grant sourcing has been spotty or not exactly 100% on reporting the income as one might on a 1099. On that sort of thing as they perhaps should have, like real estate attorneys don't report sales very faithfully, but it's still your obligation, because whether or not the IRS had advance notice of it or not, knows to watch for it, it's still your obligation to report it.
If grants are taxable, are they still worth pursuing?
Absolutely. It's unearned income. For the price of a grant application or signing an online form, or, like with PPP, it was just a matter of producing your tax records to verify what your payroll had been for the last 2 years. And I know businesses that absolutely survived because of Triple P. The stable grant made a world of difference in a lot of childcare providers that we work with, and I don't think any of them would have turned around and said it really wasn't worth it just because they got a tax bill for anything that was left or considered personal income.
What's the tax implication of receiving the revitalization grant?
Like everything else, it is just a unearned income for which benefits your center, to the extent that those proceeds are directed for a particular expense. Then those are deductible. It's usually the administrative cost that might be directed at, where the owner might be paying themselves for administering these grants. That's the part that's really going to be taxable to the owner. Now, if you're having another employee who is, you're allocating part of their salary to be covered with this grant, then it's likely those funds are going to elevate the net profit you have at the end of the year. But hey, your business next year is going to be a lot better off because of the grant you had last year. And so the tax is a very small element of what your burden is for receiving that great gift. I don't know of any other industry that has been subsidized like this since the pandemic, but I would look no gift horse in the mouth.
Can I contribute to my IRA now or wait till next year, but request that it's recorded for 2023?
April 15th to contribute into your IRA, SEP IRA, 401k, solo 401k. You're able to contribute up until April 15th, and I would definitely speak with your accountant to see what that number should be to minimize your tax liability. How
much is the percentage I can declare in my utility bill?
So it depends on whether you're using the square footage method or the hours method, but it'll depend on the square footage of the house that you're using. So for example, if you have 1,000 square foot house, you're using 100, and then 10% of that expense will be expensed against your Schedule C. So it's all a matter of percentage of what portion of the house you're using, and the utilities, repairs, maintenance will go along with that percentage.
Most of my basement is used strictly for daycare. The basement family room is only used as a playroom. I replaced a window in that room and painted the walls. Do I claim the full price of these projects or just the time space percentage?
So you can do both, but if an expense is directly related to the space that you're using for the children, then you can directly write that off. On the 8829, there's a direct expense and then not a direct expense. And so if it is something that is directly related to the space you are utilizing, then you can put it as a direct expense. So all of that would be written off. If it's not, then you would put it in as a percentage.
Can receipts be used as a proof of payment?
Receipts are required for every expense that you list on a tax return. You have to remember at the end of the day, on the second page of that 1040, every return is signed under penalty of perjury, both federal and state. And so having a receipt proving that you spent this and proof of payment is required across the board.
Okay, so in that instance, how do I prove purchases from like a garage sale?
So garage sales, normally you could prove the payment. Hopefully you're using a credit card. Cash is really hard to track, but when you are purchasing something, you should get, even if it's an Office Depot receipt, you should get some type of a record from the seller that says this is what you bought and this was the amount. If you don't have a record of receipt from a garage sale, a street vendor, whomever, there is no proof that you bought it, and the IRS cannot trace it, therefore you cannot deduct it.
Okay, and I know you've answered this, but I really want to drive it home. Do we have to save our actual receipts, or are we able to make a copy/scan of them in a program of our choosing?
So you can keep a copy and scan, which is the preferred method, putting it on OneDrive or Google Drive, but keeping the copy of the receipt is preferable to keeping the original, because the original will fade. The IRS and also the grant providers are going to want a copy of the receipt and a copy of the payment to show what happened with the funds. And so making sure that we have both of them in a way that the grant provider or the IRS examiner is able to kind of read it is ideal.
Saving, 4,000 PDFs is a lot of effort, but it makes a lot of sense to take the effort when you create that digital receipt by scanning it in your computer. Go ahead and come up with a common way that you store that document. So my method is I will date it with like a 2023-12-18 for a receipt on that date. And I'll put the dollar amount of that receipt, and I will put the receipt, whoever gave me that receipt, if it was Home Depot's, if it was Marge's garage sale. And in that way, I might even make a memo as what it was for. I just bought some new roofing materials, or I just bought a playground equipment. That helps you go through those receipts and identify what you need, if you are required to later on, much faster than having an open file with undated receipts that are one after the other over a course of several years, and you can't find what you need to prove that you actually did what you said you did.
Let me give you a real life example on audits that are done with the IRS. I had a client of mine that went through an audit on repairs on a home. We didn't only provide them the receipts or the payments, we also provided them before and after pictures of the repairs. That was, I think, a record of the quickest close of an audit I've ever seen. We faxed it on a Monday. By Friday, we got a letter saying we don't need any more proof. And so what you want from either the reconciliation audit or a tax audit, you want to close out these audits as quickly as possible, and providing as much documentation to these folks as possible is going to help you close out an audit really, really quick.
What expenses are on Form 8829 that cause a loss to my business?
So in 8829, the only expenses that will cause a loss, meaning you have a net profit that is a negative, are going to be the direct expenses to your home office. If it's the percentage, the non-direct expenses, none of those are going to ever be, they're never going to create a loss on the net profit. And so the ones that are direct, and those are very limited because they have to do with the actual space that you're using. So if there are repairs, if there's office furniture, utilities that are directly related specifically only to the space that you're using, those could cause a loss, but not the percentage ones that you're using that are an expense for the entire dwelling or the house.
How can I show proof to the IRS if they're questioning using 100% of my home for childcare?
So it's really, unless you have a property that you are using 100% for a business that you are currently not living, it's almost impossible to show that you're not using it to sleep. And so the IRS has a test where they'll come in and visit the site to see where you're sleeping. And so, for example, if there's an office space that you're using and they see children's toys in there or a bed, they will disqualify that expense. And so imagine an agent walking into your office. If they're not going to see any personal items or beds or sleeping quarters, then you should be able to use it because you don't technically live there. Nobody lives there. That is an actual expense. The entire house is used for business, then you can write that off. That's the only time it's acceptable to go 100%. But if you're living there, it's probably a good idea to not do 100%.
I see a lot of tax returns with the home office deduction taken on them. And to your point, if they have a dedicated old bedroom that isn't slept in, has a desk set up, is obviously an office space, if the IRS were to visit your home, it's my understanding that they will look in the closet to see if you have clothes hung there. And if you do, they'll indicate that as a sign that you are using that for something in addition to being an office and disallow the deduction. So just be aware of what that deduction means, and also be aware of what it does to the basis in your home when you go to sell it someday as well.
What is the legal way to hire/claim money paid to my own minor child?
So the only way that you can legally pay your minor children and write that off is through a W-2. The kids would have to be on a W-2, and the tax advantage would be to pay them less than $13,000, which is that threshold that you have to file if you're over it. And so as a tax savings tool, and a lot of this is for clients that are earning well above that S-Corp requirement, is to write a certain portion of the salary for children that are doing administrative work and being able to pay them without having federal or state taxes withheld. Paying them on a W-2 is the only way to do it. If you pay them as contractors, all you're doing is passing on the liability of the taxes to your minor children.
Is it the same thing for if I'm paying helpers who are children?
If you're paying kids that are actually working, yes, you're paying them as W-2s.
Okay, so no matter what, even if it's my 8-year-old working for me in my program.
Well, you got a different problem there, and that's called labor laws. I don't think you're supposed to be able to have a child working per se that is under the age of 12 or 14 years old without a work permit in most states. So an 8-year-old, it sounds like more of a situation where you get them to do a little light duty or task and you give them a gratuity, which I wouldn't report at all. I would just sort of eat the expense for the nice thing that you've done.
Well, the only way that you would be able to, if they're doing actual work, then yes, you're right about the labor law. The idea here is administrative work where they're picking up papers, dropping it off for you, things like that you're able to then pay them for. It is a tax saving strategy. But if they're actually in the center working and they're working for you and they're doing all the stuff that a regular employee would do, I would definitely consult with a labor lawyer to make sure that you're not breaking any state laws when it comes to that.
Should I pay my mom who works with me as an assistant with a W-2?
So this is actually a tricky one. So if we're talking about parents that are working with you, it depends on whether or not you're actually taking that deduction on a tax return. So if you are looking at that as an expense to your business and you're reporting that as a write-off, then yes, you have to pay them either a W-2 or a 1099. Remember though, 1099, you're passing on the liability to your parents. But if you're paying them with your profits after tax, then that isn't something, that's almost like you're taking the tax and you're taking the obligation and you're giving them post-tax payments. But if they're a parent that is working with you or a sibling that is working with you and you're looking to take that expense, a W-2 is really the best way to pay them because you minimize their liability. It won't affect their Social Security too much if they're not over that $18,000 annual limit. And so making sure that you kind of pay them the correct way and pay them in a way that doesn't burden them with tax liability would be the advisable way.
All of that said, there may be a more pragmatic answer for a lot of folks that isn't as complicated and wouldn't be as expensive. And that is if the parent is, maybe it's a mother of the owner that's been perhaps in the business herself and some days just sort of drops in like a 1099 employee would. But the idea of when you hear that word liability sort of chills the air. If they were to drop by every two or three times a week, or maybe just when asked for and needed to step into the nursery for a few hours or something, it might be better to let them be a volunteer officially. And if you want to do something nice for mama out of your profits later on that's not deducted, that's a more practical way just to handle it. Doesn't create the taxable income to them, doesn't create you have to have employer tax contribution. It's just a way to recognize a very informal arrangement where mom comes over when we need her, kind of thing.
So it's either volunteer or W-2, never 1099, because they're not going to be a 1099. Even if they drop in once in a while, it's not a plumber that's coming in to do a specific task. They're coming in to do a job. So volunteer and you pay them post-tax on out of your pocket, or W-2.
Hypothetical question. Let's say I pay my assistant cash, and let's say I haven't kept any records. What do I do now?
The only two things you can do is, one, give that person a 1099 come January, and that would be proof to the IRS that you had given them that amount. And then whether they pay on it or not, that's between them and the IRS. Or you would eat the taxes, meaning that would be a post-tax payment that is not deductible, right? So that would be the only two choices: paying them cash and giving them a 1099. The 1099 is proof of both payment and service, but they would be required to give you a W-9. In my years of doing W-9s and 1099s, I've never seen one provided January. Normally, you want to collect that in the beginning of the employment and not for tax filing in January or February.
How do I deduct payments made to an assistant?
You can put that as a contractor as long as you give that person a 1099 in January.
And I would get a cash receipt. Anybody you're paying in cash, get them to sign off that they received it so that you do have proof of that, because as Mohamed mentioned a few minutes ago, cash is just very hard to prove, and it becomes your word against someone else's loss of memory.
You want to pay them in a structured way. Cash, although you might have a receipt, that's great, but going forward, maybe making that a January 1 resolution that you want to pay them either through Zelle or through a check or a cashier's check. Some way that you can prove that payment is the way to go. But for the IRS, if you send out that 1099, the IRS will accept that you paid this person that amount, and they're going to extract those taxes from that contractor later.
And this may be an opportune time just to remind people that because of tax legislation last year, this year, Cash App, Zelle, Venmo, PayPal all send monthly statements. You should be collecting those if you use any one of those platforms at all, so that you've got a record of those kinds of payments in the future that you can recover. A lot easier and cheaper to do it now than to go back and say to PayPal, I need my 2018 statements. Well, they may not exist in 2018, but get them every year, put them in a file folder somewhere on your storage drive, and be satisfied you're prepared.
If you work a job outside your childcare business, are you able to utilize all the deductions such as your health insurance, utilities, etc.?
On a W-2 job, no. So let's just say you have a W-2 position. The only things that you're able to write off is going to be your 401k contributions, normally on box number 12 with a letter D, would be a reduction of your wages. But when you have a W-2 income, that is your starting point with your adjusted gross income. When you add in your Schedule C profit, that'll just add to it. But it limits the amount of write-offs that you have on a W-2. W-2, you're in the tax-paying business. When you have a small business, you're able to write off a lot of business expenses on there that are a lot more than on a W-2. So it's always advisable to get paid as a contractor. But I would say if you're looking for deductions on a W-2, there's probably two of them.